Ellos nos van a ver a nosotros solamente el cuadro, ¿cierto?
Mr. Dario, hello.
How are you, Philip?
I'm very
Good
well.
to
How
see
are
you.
you?
Fine, thank you.
Is your knee progressing?
Thank you very much. Yes, I am now okay.
Excellent.
Thank you.
That's good to hear.
Okay, and thank you very much for your participation in this. I think you will find it very interesting. I hope.
I'm sure I will.
Thank you.
Okay, we are ready now. Hello, everyone joining us from different places around the world. I'm Carlos Giraldo, Chief Economist of Latin American Research Fund. I want to thank Professor Turner for accepting our invitation to share the results of the Robert Triffin Foundation report on global liquidity. We also want to thank these webinar's participants and attendants from central banks, finance ministers, multilateral organizations, academia, think tanks, and other important institutions. It is a pleasure to be accompanied today by FLAR's Executive President, Dr. Jose Dario Uribe, who will give the introductory remarks. Dr. Uribe, the floor is yours.
Thank you. First, let me say good evening in Asia and good afternoon in Europe and Asia, and good morning here in the American continent. I thank Philip Turner for kindly accepting our invitation to present his recent research on global liquidity, and to all attendants for different latitudes and institutions. The main purpose of the Latin American Research Fund, FLAR, is to contribute to the well-being of the region by promoting its macroeconomic and financial stability. That is why it promotes dialogue with spaces such as this one, intended to bring together economic authorities, technical teams, representatives of international institutions, think tanks, academic institutions, and social actors from Latin America and the world. After the global financial crisis, the world economy has experienced a period of extraordinary liquidity coming from the major central banks, which may be duly justified in light of events in the global economy. However, at the same time, major risks may emerge as a result of this excess liquidity situation. The report of the Robert Triffin Foundation on Global Liquidity analyzed the magnitudes of the balance sheet effects and diagnosis vulnerability in several economies, as well as economic policy options to address them. Philip Turner, as co-author, will present the main elements of and conclusion of this report. Probably all or most of you know Professor Turner's credentials. Personally, I think I met Philip and I have been learning from Philip for more than 20 years. However, I would like to mention just a small part of his biography. Professor Turner is a visiting fellow at the National Institute of Economic and Social Research and at the University of Basel. Formerly, he was deputy head of the Monetary and Economic Department and member of the senior management of the Bank of International Settlements. Earlier positions include work at the OECD in Paris and as a visiting scholar at the Bank of Japan. He earned his degree in economics at Churchill College, Cambridge, and he has a PhD from Harvard University. Philip is a contributory editor to Central Banking, writing regularly for the Viewpoint column, which brings together timely analysis from experts across the globe. And he is also a renowned expert on global liquidity. Having said that, I wish you a very fruitful dialogue.
Mr. Dario, thank you very much indeed. it is indeed around 20 years since we've been collaborating. I think we've been in meetings in Europe, Latin America, and in Asia. So I think that's a difficult record to beat. Well, I can summarize the RTI report.
Professor Turner, let me explain the format of the webinar, and I give you the words. Sorry, it will be very, very short to the participants. Yes, okay. The webinar formats is as follows. We will begin with Professor Turner's presentation, which will last about 40 minutes, using his slides from a PowerPoint file. After this presentation, we will dedicate around 20 minutes to discuss and address questions and comments from the audience. We will ask the questions selected from those the participants sent in the registration process. You can also send more questions during the Professor Turner's presentation. And thank you, Professor. Sorry for interrupting you. Now I'm pleased to give the floor to you.
Carlos, thank you very much indeed. Well, the conclusion of the RTI report can be stated in one sentence. There's a large and increasing risk of a dollar liquidity crunch. Now, many people have attacked the Federal Reserve and other central banks for creating excess liquidity. Jose Dario referred to this. These attacks are misguided, in my view, because low rates and massive liquidity creation by the central banks prevented a world depression. It wasn't inflationary, and it did not produce the financial crisis that many people were worried about. But as Jose Dario mentioned, these attacks reflect very understandable worries. Financial press is full of articles about a liquidity reversal. Investors know they have to get out ahead of any liquidity crunch. And the authorities, central banks and governments in most advanced economies won't tell you this, but they do their best to hide their worries about a liquidity-induced crash in global markets. It's clear that a decade of low interest rates has had massive effects on balance sheets. Higher leverage, increased currency mismatches, and an underpricing of liquidity have transformed risk exposures worldwide. Dollar liquidity crunch is important because it would hit even prudent borrowers and investment managers. So that's why I think it's essential to think hard about global liquidity. The problem, of course, is that global liquidity has no simple, clear definition. It's an elusive or connotative term. It means things, but it doesn't have any unique meaning. And the corollary of that is there's no single killer statistic for global liquidity. But the boom in foreign currency credit worldwide since the crisis is unprecedented. Large dollar debts of many emerging market companies risk creating destabilizing dynamics in foreign exchange markets. And equally important, regulation, among other factors, have made bond and interest rate markets more pro-cyclical. So two new destabilizing elements in the system. The dollar's become even more dominant than it was before the crisis. And the dollar exposures of non-US banks are huge. Problem for the Fed is it cannot quantify how these huge dollar balances outside the United States will change the macroeconomic effects when they change monetary policy. So in that sense, the global financial system has become fragile and harder to manage. I shall look behind BIS and IMF indicators of global liquidity and ask several questions. Let me just briefly give you these questions. How have currency mismatches developed? Has the greater reliance on bond markets pushed risks into regulatory blind spots? What does the time premium on the world long-term interest rate tell us about the price of global liquidity? Can the non-global banks really provide dollar lending on such a massive scale and do so safely? Now we know during upswings, increased leverage facilitates an easy expansion of private liquidity. But in downswings, this reverses. And in the global financial crisis, as you remember, private liquidity just imploded. One simple statistic on that is global interbank claims. They fell from $9 trillion in early 2008 to less than $6 trillion in the end of 2009. And markets simply froze. Second number on prices. In 2010, the IMF's indicated the price of liquidity in short-term wholesale markets had risen continuously over the previous 2 to 3 years. And it reached a peak of 5 standard deviations above normal. The world term premium in long-term rates, this is on the graph on the next slide, continued to rise until 2010. Now, this is highly unusual in a global recession. And it arose because fears of liquidity were not temporary fears, but they haunted markets for several years. Now, of course, the key to breaking this was the Fed provided unlimited swap lines to central banks in the major financial centers. Because it was a crisis, after all, that originated in the United States. And it was not a crisis the Federal Reserve had foreseen. So they had little option but to act. All other major central banks used very unconventional tools to create official liquidity on an unprecedented scale. I think the next slide, please. Yeah, and the question is, what will happen? What will happen for lender of last resort facilities on the official side next time? You remember last time the Federal Reserve faced huge political criticism for lending to foreign banks. Now, since international bank lending in dollars has now exceeded pre-crisis levels, it's hardly surprising the Fed is concerned about this. They've warned both the Bank of Japan and the ECB about the dollar exposures of some large banks in Europe and Japan. Now remember, the Dodd-Frank Act had constrained the lender of last resorts of the Fed, even to banks based in the United States. Tim Geithner pointed this out, and he pointed out the dangers in his Per Jacobson lectures 2 or 3 years ago. Contrary to some perceptions, these swap arrangements are not automatic. The ECB, for example, must ask the Fed. And the Fed can always say, yes, but, and then impose conditions which their counterpart central bank may not like. The whole history of banking crisis, however, tells us that any hesitation or delay in the provision of emergency liquidity assistance in the early stages of the crisis will only make matters worse. So the next 2 slides and cover 2 major issues which I would like to mention. They're covered in the RTI report, and the slides give you some brief detail of it. The first point is that there are many unresolved technical problems that could limit or delay the activation of central bank swap lines. As in many other aspects of central bank policies, the devil is in the details. Second point is that the divergence between the Federal Reserve and ECB balance sheets has effects on exchange markets, and in particular, it affects the euro-dollar cross rate, which itself has important implications for the financial system. So let me now turn to the standard measures of global liquidity. The BIS uses aggregate foreign currency credit. This is the next slide. An aggregate foreign currency credit is simply the sum of bank loans and bond issuance. to non-banks. Now, this has been growing at 5% a year since the crisis. This measure is okay as a first approximation, but it has two big shortcomings. The first is that it makes no distinction on the maturity of liabilities. And of course, a borrower with short-term liabilities has far greater liquidity risks than one with longer-term debts. So we need to know about the proportion of dollar liabilities that fall due in the next 6 to 12 months, for instance. The second shortcoming is that the BIS reports gross liabilities. What it needs to do is subtract foreign currency assets, because you need net liabilities to get at currency mismatches. So, for example, you can look at some of the financial transactions of, say, a large Japanese, like Alibaba, large Chinese company in dollar markets, and it will often go through an offshore center. And the debt part, the dollar debt that is created by this transaction, is captured by the statistics. But on the other side, the company has acquired substantial dollar assets in offshore centers, and that second part is not subtracted. But what the BIS indicator does show is that the strong growth of gross credits relative to GDP. So in this sense, there's strong prima facie evidence of increased leveraged in dollar positions. If you look at the next slide, this aggregate now stands at $12 trillion. Now that's 14% of GDP. 2007, it was around 10% of GDP. And at that time, everybody thought that the dollar exposures had become too large and would be a powerful accelerating factor of any crisis. But it is now significantly higher. More importantly, perhaps, lending through bond markets has increased. Lending through bank loans has grown much less rapidly. And because of this, new and opaque risks have been created. And these risks are largely outside the regulatory perimeter. The other notable feature is there's been a particularly rapid growth of credits to the emerging markets. You can see from the graph on this graph, that's right, you can see from this graph that the dotted black line, that is dollar bond issuance, has overtaken the continuous line, that's international bank loans. Now from 2009 to 2015, this expansion was led by dollar credits. Now this is of course very significant. What it means is that the hunger in the world on the part of investment managers for dollar assets, which is a major driver of the global financial crisis, has not in any sense abated. International portfolios have very high dollar weights. The ideas that the hopes that people entertained maybe 10, 15 years ago that international bond portfolios would be more diversified in terms of currencies have not materialized. Now, the strong demand for dollar bonds and low yields on US treasuries has allowed non-US companies to issue dollar bonds on an unprecedented scale. In addition, non-US banks must do most of their international business in dollars. Large expansions of foreign currency credit create currency mismatches. They also create a maturity exposures in foreign currency, because typically banks that finance, that borrow long-term, that borrow short-term, use the proceeds to invest in long-term assets, so that even though they may not have an aggregate currency mismatch because their dollar borrowing matches their dollar assets, they do have a maturity exposure. Now, currency mismatches, as you know, aggravated the financial crisis in the emerging markets in the 1980s and 1990s. But by the time the global financial crisis struck, aggregate currency mismatches in the emerging markets had been largely eliminated. Since then, however, they've started to come back. And because they're concentrated in the private sector, they're more dangerous. If you look at this graph here, this shows net foreign currency assets, which is simply foreign currency assets minus foreign currency liabilities as a percentage of exports. The dotted red line shows this at the top, shows this for the country as a whole. This is not positive. This is now positive, not negative as it was in the 1990s. So this means that the country's balance sheet as a whole appreciates when the currency depreciates, because the country has more foreign currency assets than it has foreign currency liabilities. And this is an important stabilizing factor with respect to exchange shocks. But this positive foreign currency asset position is almost entirely in the official sector, and it reflects very large official holdings of foreign exchange reserves. Private sector is in a completely different position. It has a large and rising net liability position in foreign currency. For an aggregate of medium-sized emerging market economies, in other words, taking out India, China, and Russia, and Korea, which are influenced by somewhat different forces, net foreign currency liabilities are now almost 40% of annual exports. Now, this has been driven, as I said, by increased bond issuance by emerging market companies. Now, these bonds are pretty illiquid, but investors hold them typically via bond funds because they get an interest rate pickup, and because they hold them as a diversified portfolio in a fund, they nurture the illusion that their portfolio is more liquid than it really is. Higher dollar debts of the private sector can make the foreign exchange market more unstable. And this is because private companies, that have large dollar debts, when they're confronted with fears of depreciation, know that their own balance sheet is at risk, and so they react by buying dollars. And this adds to downward pressure on the currency in a crisis. So in a sense, it aggravates the downward movement of a currency in a crisis. Now, such dollar purchases will be financed by selling domestic assets. Local bond market becomes more turbulent, and local banks suffer. This contagion is quite important. I'll come back to it in a moment. But for the moment, let's go to the next slide and take a closer look at the boom in international bond markets. Before the global financial crisis, expansion in global credit came from the big international banks. Since then, it's come from capital markets. Just one striking statistic. Dollar bonds issued by non-banks outside the US now stand at $6 trillion, compared with $2 trillion in 2007. So an increase of $4 trillion. If you go ahead to the slide after the next one, slide 21, you can see the gray part of this graph shows how the share of dollar bonds in total international credit has risen since the crisis. And that of banks, the black line, has fallen. The greater use of capital markets make risks more opaque and much harder to manage than if the intermediation had taken place through international banks. So let's go back to the preceding slide, slide 20. Companies in Latin America and emerging Asia with big dollar debts usually have large portfolios of local currency assets. So these are not necessarily countries that overall financial position is weak. And this sounds reassuring, but is it? The answer is not necessarily. The not necessarily part is that it creates new channels of contagion from a dollar liquidity crunch to local markets. Because local companies will draw down their deposits with the local banks, and they may even activate credit lines. Bank credit to the rest of the economy can be squeezed, and the banks may be constrained to extend credit to these borrowers at terms much more favorable than they would normally extend credit in a crisis. There's quite a lot of evidence, both from studies at the BIS and from those at the IMF, that such dynamics lower real investment and weaken growth. And this, of course, is related to the question of whether exchange rate movements are amplifying forces or stabilizing forces when a country is hit by a shock. It's not that the exchange rate mechanisms per se are necessarily amplify crises, but it's that the balance sheet of local borrowers that have dollar debts may unleash contagion in the local financial system, which has such an effect. Slide 22, the heavy reliance on bond markets creates vulnerabilities. There's a lot of people who've written about this. I don't want to go into great detail. The greatest worry, and one most relevant for the liquidity point, is that asset managers worldwide collectively suffer from a liquidity illusion. They invest in instant access funds that have a daily price, but the underlying assets of such funds are illiquid. Mark Carney, the governor of the Bank of England, said such funds are built on a lie. You might ask him, well, why didn't he regulate them before? And I'll come back to that. Second worry is that the credit quality of non-financial companies has deteriorated. A large proportion of these companies now totters on the BBB cliff edge, the cliff edge between being investment grade and junk. Many investment managers, remember, are constrained to invest only in investment grade bonds, so that once a company's bonds fall into junk, they are forced to divest themselves of investments in that company. Kraft Heinz has just joined the junk pile, and it won't be the last company to join them. Third, the longer average maturity of bond issuance makes bond investors more edgy about increased market risk from a sudden rise of interest rates. And they're particularly edgy because they may end up facing market risk at the same time that they face great credit risks on their counterparty exposures. So the risk of a bond market crisis of some form has risen. Investors may actually be more flight prone once they think investors are going to go up and the defaults may rise. Leveraged investors in particular will have to run very, very fast. And so that bond markets could well become more volatile and less liquid in the next recession. Now we've seen a couple of spikes in bond market volatility in the past year or so. I wonder about the stress in dollar repo markets we saw last September, which has recurred periodically since. We know that non-banks with bond portfolios have become more important users of dollar repo markets than they were before the crisis. The relative position of banks has fallen, and those non-banks with bond portfolios has gone up. We need to know much more about the role of hedge funds. Some of the intermediation of these non-bank players may actually be going through banks, so it may not be easy to get a fix on the non-bank participation in repo markets. In any event, investment funds using repos to fund portfolios of risky bonds played an important part in recent repo market stress, and one needs to keep an eye on whether, to what extent, new factors are playing on repo market pressures in the United States. Slide 24, very briefly. Recent regulations, Basel III, Solvency II, accounting reforms, have created a pro-cyclical dynamic in bond duration. And by that I mean that the regulations in effect have the consequence of inducing regulated investors to buy more longer dated securities when the interest rate goes down. They may do so for various reasons. But this is a pro-cyclical movement. It means that you buy more bonds after the price of them has gone up. A stabilizing thing will be to buy fewer bonds, to buy fewer bonds when the price has risen. The IMF has noticed a similar tendency in interest rate markets, interest rate derivative markets, and that benchmark interest rate markets have become more pro-cyclical also. And this is destabilizing. So that a fall in market rates induces further falls. Now, once central banks begin to raise rates, they may trigger a similar dynamic, but in the opposite direction. Now, the last crisis showed that banks had failed to prepare for a liquidity crisis. The regulators have done their best to correct that, notably in Basel III with the liquidity ratios. But they've not addressed the liquidity risks in capital markets. The danger is that contagion could spread illiquidity across the whole universe of high-risk bonds, emerging market companies, high-yield paper, the advanced economies, and so on. And this could trigger distressed sales across the asset management industry. During the past year or so, we've seen a couple of instances of what looks like this. Several funds facing crisis were found to have their investments in virtually non-tradable or even unlisted paper. And regulation clearly needs to fix this. The macroprudential surveillance of maturity mismatches and leverage in non-banks is practically non-existent. And third, the liquidity rules for banks, which are still constant ratios, unlike the capital ratios, which have a counter-cyclical buffer, the liquidity rate rules for banks should be adjusted in a counter-cyclical way. And they should be adjusted when market liquidity conditions surpass certain thresholds. So that when market liquidity seems to be excessive, then the regulator should be more demanding on the liquidity they require of their banks. And when there is a liquidity squeeze, the regulator should encourage the banks to use the liquidity buffers. Special attention, of course, needs to be given to dollar liquidity risks because the local central bank has limited capacity to affect that. Let me turn to the question of a simple price indicator for global liquidity. There is no single indicator. As I've said, global liquidity is a complex, diverse phenomenon. But I think that the term premium in world bond markets might be regarded as one useful indicator. The reason is that foreign currency borrowing in bond markets has become the key component of private global liquidity. In the past, it was short-term bank loans in dollars, but no more. It's dollar borrowing in bond markets. Hence, the long-term interest rate and global liquidity are now linked together in a way they were not in the past. Most famous exposition, those of you who are old enough to remember all the old textbooks of this link, was Keynes's liquidity preference theory. His insight was that the long-term rate is moved by shifts in the private sector's willingness to assume liquidity and maturity risks, even when other macroeconomic variables don't change. Keynes believed, as you know, that the future path of the long-term rate, his famous chapter on the state of long-term expectations in general theory, was unknowable. We would now say it's radically uncertain. It's radically uncertain because too little is known about future fundamentals. Hence, subjective factors dominated liquidity preference. And if you look at the past 15 years, it's clear that our ability to forecast a 10-year yield on US Treasuries, even a year ahead, is poor. I don't think there's any major variable, macroeconomic variable, where the consensus forecast has performed as badly as in the year ahead forecast of the 10-year yield. And this is a central price in the financial system. Long-term rates are determined in world markets. And this helps to explain why the Federal Reserve, why the 10-year US, it's the next graph actually. There's a graph with the slide 27, what's that? Well, anyway, it's a graph which compares the short-term interest rate of the United States. And what it shows is if you look at the Fed tightening, including an attempt to quantify this is the graph, including the effect to quantify the balance sheet policies, what you find is this steady progress of tightening monetary policy, where the Fed funds rate, when quantitative easing is very important, is actually negative. You have a shadow funds rate. The gradual increase in the Fed funds rate had absolutely no effect on the 10-year yield. It's very difficult to see any trend in the 10-year yield. And what happened, of course, is that low euro yields have been holding down dollar yields because there's a world capital market. Now, the world long-term rate can be split into two components: the long-run expected short rate and a term premium. Term premium, this is slide 28, the next slide. Yeah, the term premium reflects, it reflects at least three elements: an inflation risk premium, a real interest rate risk premium, and a liquidity risk premium. You can pick up the next graph which shows the term premium in the world long-term rate. Yes, the term premium in the world long-term rate is the blue line in this graph. And it's still negative. Indeed, it's a record negative. Now, why is it a record negative? Very difficult to know. It's almost impossible to know which of the three determinants I mentioned is really driving that. We know it doesn't appear to be the inflation risk premium. It may be the real interest rate risk premium, or it may be a liquidity risk premium, which we can't really measure very well. Now, it's not hard to think of scenarios under which the term premium might snap back into positive territory. Inflation risk seems likely to rise the longer the United States remains close to full employment. But the truth is, we just don't know. Keynes, in the end, perhaps will be proved right. The future long-term rate will surprise us. Before concluding, let me mention the vulnerabilities faced by non-US global banks in their dollar lending. This is slide 29. We know that their liabilities exceed the total liabilities of banks operating in the United States. The IMF recently identified a dollar funding gap of $1.4 trillion. This funding gap is plugged by derivatives, notably forex swaps. And this, of course, is a short-term and very volatile form of funding. Dollar intermediation without a clear lender of last resort. This is the expression of Agustin Carstens, the general manager of the BIS, who rightly talks about a policy vacuum. Who is going to be the lender of the last resort when the dollar liquidity crunch comes? So let me now reach my conclusions and quickly recap. There is no simple definition of global liquidity, no killer statistic, but virtually all the standard indicators are flashing red. Many are at record levels, strongly suggesting substantial vulnerabilities. There is also much greater risk of pro-cyclical or destabilizing market dynamics. mention the point about Forex markets, because where you have private sector borrowers with large dollar debts, they themselves can destabilize the foreign exchange market. Regulation has contributed to making bond and interest rate markets more pro-cyclical. Policy action to deal with this before the crisis should involve many actors. Let me just briefly mention some principles. Liquidity regulation should be tightened when global conditions are easy, that is now. I'm afraid it is more likely that action will come only after a liquidity crisis. That was the lesson of the global financial crisis. The regulators tightened liquidity conditions when the markets had already begun to withdraw liquidity. Second, governments should counter any large and unwarranted spike in liquidity risk premia in their bond markets. Most important, the world's de facto central bank is in a fix. Huge dollar debts outside the US will make the Fed's task very hard. They will have to work out what is causing any dollar liquidity crunch when it happens. And they will also have to try to quantify what are going to be the macroeconomic effects outside the United States of such a dollar liquidity crunch. And both of those calculations are very difficult. It would be wrong to blame the Federal Reserve for the so-called excess liquidity that was created after the crisis, because the Federal Reserve did far better than the other central banks in acting earlier. The ECB acted very poorly in dealing with not only with the initial crisis, but in also failing to deal promptly with their own crisis. But nevertheless, the task of dealing with this will fall on the Federal Reserve, and it will not be easy. Internationally, there's a policy paralysis. I think the policy paralysis is due to the fact that countries disagree about monetary policy, they disagree about regulatory policy, they disagree about fiscal policy. So they think it's better not to talk about it. So I think the likelihood is, as Ambrose Evans Pritchard said in his Daily Telegraph review of our report, he asks, well, will anything be done? Not likely, he said. And I'm afraid that is the conclusion I share. So thank you. I'm happy to take questions, and I've stayed more or less within the 40 minutes. Hello, I can't hear you. I still can't hear you.
Okay.
All right, now I can hear you.
No. Okay, thank you very much, Professor Turner, for your very interesting and illustrative presentation. Now, as I mentioned before, I will raise some questions from the audience. In view of the time constraints, we only address some questions live. However, all the other questions we will send to Philip Turner via email if Professor Turner agrees with that.
Yes.
So, okay.
That will be fine.
Okay, thank you, Professor. Now I'm going to read a first group of 5 questions. Maybe I recommend to read each one, and then we see your answer, and then continue with the second one, and so on. So the first question.
Do you want me to answer one question at a time, or wait to the end?
Yes.
All the time.
All the time.
Each one.
Each one.
Each one.
Each one.
Yes.
Okay. Righto.
Each one.
Okay. Good.
Yes. I'm going with the first question.
Okay.
The first question is regarding, or it says the following. Clearly, risks and vulnerabilities are increasing around the world, and they call not only for local, but also for international policy responses. Could you elaborate further on the kind of international policy response or the elements that would be required, taking into account your presentation?
Thank you. Yes, I think the first thing is that the liquidity rules on capital market intermediation need to be improved, so that if investors are investing in illiquid bond markets, then they should be aware that is what they are investing in, and that the attempts of some asset managers and the creation of, say, benchmark indices in bonds, which create the illusion that by putting all these bonds together, you make your exposure more liquid than it really is. Regulators should work against that illusion. That's the first thing. Secondly, the weight on the United States to provide, the weight on the dollar to provide safe assets is too great. There is no reason why the supply from the euro area of safe assets should not be larger. That means the less restrictive fiscal policy in those countries which are busily trying to reduce the volume of government debt at the time when their own financial institutions have a hunger for the safe assets, say, issued by Germany. And the supply of safe assets could also be increased by the issuance of bonds by the European institutions collectively. And I think the third thing is that regulators of countries that have large foreign currency exposures in their borrowing should ensure that stronger buffers, there are stronger liquidity buffers in place.
Thank you, Professor. This is connected with the second question, that is the following. And he mentioned, or he asked for this. What kind of domestic policies could be more effective for emerging markets to act in the event of a US liquidity crunch? Could you elaborate further in the case of partially dollarized economies, more vulnerable due to domestic currency mismatches? So the situation is more complex in this kind of economies.
Yes, I think if they're partially dollarized economies, they have little scope for using monetary policy, which would be my normal recommendation. What they do have scope for is for countering any spikes of liquidity risk premium in their market. If they're going to do that, it needs to be a country that has issued government bonds of different maturities in their own country and have established an investor base within their own country. Then they have greater capacity to stabilize themselves in the event of a shock, but by simply changing the maturity of the bonds they issue. So that if the government is traditionally issuing 10-year bonds, but then they're faced in a partially dollarized economy, and they're faced with a flight away from 10-year bonds, then what they should do is they should issue more short-term securities or write some form of options which protects investors of long-term bonds against worst outcomes, because they may be in a situation where the local financial institutions is quite happy to buy the local dollar-denominated bonds because they have a higher yield, and they're prepared to take some risk because they are getting a higher yield, but they need some protection against tail risk, and you may be able to do that by options written by the central bank or government.
Thank you, Philip. Now we have a question that is more related to regional responses, and is the following. What could be the role of regional financing arrangements such as the European Stability Mechanism, the Shanghai Multilateralization Initiative, the Eurasian Fund for Stabilization and Development, and the Latin American Reserve Fund, FLAR, to deal with a potential liquidity crunch? Can RFAs play a more important role today than they did in the global financial crisis?
I think, yes. I think, I've got something on my screen. Yes, I think it very much depends on how the regional financing arrangement is devised. It is important to develop mechanisms that provide a ready supply, make the supply of funds readier and available more quickly, in return for better precautionary policies before such funds are needed. Now, there's been a big debate about that in Europe in the ESM mechanisms, that trying to put in place mechanisms which allow for euro area-wide lending to banks that get into difficulty, but subject to countries agreeing to better surveillance of their macroeconomic policies, and also surveillance of the regulation of the local banks. So I think it's difficult to provide a generic answer to that question, but it is very important to prepare before the crisis, so that the vulnerabilities are less, and that countries, in a sense, are buying some form in the mechanisms that get set up. They are in effect buying some insurance, which in a crisis can be very helpful.
Thank you, Professor. The time is running out, but therefore we have time for 2 more questions. The rest of the questions we will send via email to Professor Turner. And the following question is this. How could global geopolitical events affect the risk of the US liquidity crunch you referred to during your presentation?
Well, I think typically during global crises, there's a flight towards the dollar, and so that could accentuate the global dollar liquidity crunch. In some cases, there has been an attempt by a number of large countries to move away from dependence on the dollar, China and Russia in particular, and so that some of the global conflicts have paradoxically reduced the risk of a dollar liquidity crunch for them, because they've been forced or induced or decided to reduce their connection with US finance. So it's difficult really to generalize. One thing I've been thinking of recently is what might be the repercussions of this coronavirus on China, because it's Chinese companies that have very large dollar debts, and these dollar debts create a vulnerability in any events. The vulnerability, if output were to be weak for a prolonged period in China, or if the business model of heavy reliance of countries outside China on the supply chains in China came into question, then this could aggravate the risk of a dollar liquidity crunch, because it could trigger a scramble for dollars by Chinese companies.
Thank you, Philip. And we have time for one last question, and it's the following. I would like to add a dimension to your analysis regarding the emergence of private digital currencies around the world. The speed at which new technologies and private crypto assets evolve may result in a lack supervision and regulation in many countries, and at the same time, this could be a new source of volatility for cross-border capital flows and external liquidity. In your opinion, how could the existence and the possible increase in the use of crypto assets affect the conclusions of this study?
Well, that's a very difficult question. Mark Carney, as you know, gave a speech at Jackson Hole saying that the development of technology may actually allow in the medium term the dependence of the dollar to be reduced. And it is certainly the case that the People's Bank of China is developing ways of making their currency more digitally friendly, and that they may be ahead of other countries in doing that. But that is not what you asked. That is not really a private digital currency. This is a digitalization of the central bank currency. I think in the event of a crisis, people would go back to what they know best, which would be the dollar or the euro or the Swiss franc. I don't think they would go into private digital currencies, because the big distinction of a currency that has a central bank behind it, either the euro, the dollar, or Swiss franc, is that there is a central bank there stabilizing, in some sense, the financial transactions, at least within its own borders, in that currency. Now, with private digital currencies, there's no such stabilizing force. So I think I don't believe that would. I don't believe that would in any way soften the impact of a liquidity crunch.
Thank you, Philip. Fortunately, we have 5 minutes, so we have time for other questions, and it's more related to Latin America. And this question says the following. Latin America has experienced a low economic growth over the past 5 years. Moreover, is still adjusting to the new external financing levels and terms of trade. In a context marked by increasing public and private indebtedness and high volatility in the international financial markets, at the same time, governments have encountered difficulties when trying to implement structural reforms that may contribute towards economic growth. In light of these restrictions, what do you believe should be the priority to mitigate the effects of an eventual sudden stop of capital flows toward the region's economies? It is a more general question.
I think in the event of a sudden stop to capital flows in the country, what would be important is to find some way of preventing the sudden stop of capital flows, bringing to a halt real investment taking place in the country. Because presumably, like anywhere else, the government and the private sector have many long-term projects. And typically when the external environment deteriorates, they are the first projects to be cut, the first form of spending to be cut, rather than trying to reduce private consumption and to maintain the capital expenditure. But that is easier said than done. I think one important criterion, well, one of the most important criterion is to the extent that you can mitigate a decline in real fixed investment of any program. That I think is one criterion in deciding what policies to follow. And the second criterion is you have to make sure that you don't have a banking crisis that aggravates the contraction of credit coming from the outside.
Thank you, Professor.
Not sure it's a satisfactory answer, but anyway.
No, very good. Thank you, Philippe, very much.
Thank you very much.
It's going to be very, very useful for all of us, for all the participants. let me thank all participants. As I said at the beginning, we have participants attending this webinar in Asia, in Europe, and here in Latin America. We will continue thinking on this subject.
Thank you.
And we will continue bothering you and learning from you. So as I said at the beginning, for FLAR, FLAR is the key of FLAR is not only in its original function of lending for balance of payment lending, but we also want to contribute to discuss all these type of things and to identify risk and vulnerabilities and solutions to that. And this is exactly the idea of this webinar with you. So we finish here at 11, as I was 11 time here in this side of the world. And thank you so much.
Thank you very much indeed. It's been most interesting, and I hope people do send emails, and I'll do my best to respond to them. I think it's important that institutions such as FLAR raise consciousness about how important these collective global liquidity issues really are. Thank you.
Thank you very much.
Thank you.
Thanks.
Bye.
Bye-bye. Thanks.